Hey guys, thanks for tuning in. If you haven't seen my videos before, I like to talk about personal finance, investing, and lifestyle tips. That being said, let's get right into it. So in this video, I want to talk about options, and then I also want to briefly explain short selling and kind of the difference between the two. So options are financial instruments that are derivatives that are based on the value of an underlying stock, and it gives you, the investor, an option, not an obligation, to either purchase or sell an underlying asset. So a derivative is something that has the value that's contingent on an asset. For instance, if I was to buy an Apple option, that option is based on the value of the Apple stock. There are a couple of things that you need to know in order to understand options. So the first thing is that an option is a contract of 100 shares. So when you purchase one option, you are getting a contract that has 100 shares in it. Options are priced at a premium price. So you purchase an option, you pay the premium. But the premium price that is shown on an option is the price per share. So in order to get the overall premium price of a particular option, you need to multiply the premium price given by 100 shares. Next, you have the expiration date. The expiration date is when that particular option expires. Whether it's a week, a month, a couple months, that is when it will expire, and you need to exercise, sell, or not sell, and then just wait for it to completely expire. Then you have the strike price. The strike price is going to be the price that is on the option, and it's the price you either buy in terms of a call or you sell in terms of a put. So let's say I bought an option that had a strike price of 50, so I want to exercise that particular option. I'm going to purchase the shares at $50 each, and I will touch on that a little bit later. And then you have the current stock price. The current stock price is just good to know whether your option is in the money, out of the money, or at the money. Some terms that investors like to use to describe the relation between the stock price and the strike price. So in the money is that the option is already profitable when you purchase. Out of the money is when it's not profitable when you first purchase. At the money is going to be, it's exactly the same price as the stock. So like I mentioned a little earlier, there are two types of options: a call and a put. So a call is typically for an investor that is bullish on a particular stock. They believe it's going to go up in the future. So they will purchase this option, which will give them the right, but not the obligation, to purchase that underlying asset on or before expiration date. And then you have a put. A put is for a bearish investor that believes the stock price is going to go down in the future. So with this option, the investor will have the right, but not the obligation, to sell an underlying asset at the strike price before or on expiration date. So you bought an option. So how do you profit off of an option? So there are two ways to profit from this option. You can exercise the option in terms of a call. That means you're going to buy the underlying asset before or on date of expiration, and you would buy the asset at the strike price. So let's say that the stock price jumped to $50. You bought an option with strike price at $20. You're going to buy that asset at $20. But then it's worth $50, so it's going to be a $30 gain on that sale. In terms of a put, let's say you bought a put with a strike price of $20, the actual stock price dropped to $10. You're going to be able to sell the stocks at that $20, so you're going to make the difference between the 20 and the 10. $10 would be your profit. The second way you can handle your option is to sell the option contract. So you bought it at a premium price, and then you sell it to another investor. So you would then make that premium of what the investor paid, and then you subtract that from what you actually paid, and the difference is how much you're going to profit from that option. Lastly, you could let your option expire, and then all you lose is your premium that you paid. There are pros and cons of options trading. So some benefits include that it's a finite horizon. You only own the option for a little bit. Once it expires, you're completely untied from that particular asset. It's a lower upfront investment. Typically, you pay that premium for a 100-share contract. You don't have to pay the actual stock price, which is nice if you are just trying to do some short-term gains. It's another form of leverage. You increase your benefit by taking on risk with small amounts of your own money. And then lastly, you can hedge against your risk. You buy the actual stock and then you buy a put. So then you're covered on both ends of the spectrum. Possible downsides is that you don't own the stock. So, if the stock really performs well in terms of a call, you're not going to have a tie to that company. Once your option expires, you trade it, it's over. The main thing about options that is difficult for early investors is that it's about timing. So you kind of have to be more attentive to your portfolio and really and really pay attention to how a stock is performing any particular day and what day it is, where you are in your contract and whatnot. It definitely takes a lot more involvement from an investor. And then another thing that's a big issue is that you got to know when to cut your losses and go, or take your profit and go, and don't be greedy about it. It's really difficult to see a certain profit and be like, oh, it could go up more, and then kind of leave it and then see it dip. I actually experienced this in the summer. I had an option and I saw my profits go, really high, and I really liked it, and I was like, oh, it could go up more, and it ended up dropping, and I didn't make as much profit as I could have if I would have just been less greedy and just pulled out. Hey, before I wrap this video up, I really want to shed some light on short selling, just because of how relevant it is this week especially, and how it's kind of contributing to this bubble per se that we're kind of in this week with stock prices such as AMC and GameStop. So short selling is a financial strategy where an investor who believes that a stock price will go down in the future will borrow a stock from a broker, take the stock, sell it for the current price, and then take that money and hold it. And then they will wait for that particular stock to drop in its price, and then they will repurchase the stock, and then they will give the stock back to the broker. So the profit made there is the difference between what they sold it for at the beginning and then what they bought it for at the end. It sounds like a pretty solid strategy, but it definitely has a lot of risk. Say you borrowed an asset from the broker and it was $20. It was a $20 share. Then you went and sold it, you have $20. But that stock that you sold, if it jumps in price, let's say to $40, you're not only spending that $20 you made, but also $20 from your own pocket to repurchase the share in order to give back to the broker. So there is unlimited risk in this type of investing. So the main difference between options and short selling is that with options, you are cut. There's not unlimited downside risk. You are going to lose your premium, and that is the most you can lose. Short selling, there's unlimited amount of risk. You can lose everything. Because if that stock price keeps climbing and climbing and climbing, you have to pay the difference in that. You're going to have to pay that right out of your pocket. So it can bankrupt and really destroy funds. And this is kind of what happened with the hedge funds, as they were short selling companies such as GameStop, but then they jumped up to like $400, so they had to repurchase the shares in GameStop at $400 versus what they sold it as, probably like $15. So they had to pay that right out of their pocket in order to give it back to the actual broker. That being said, I just wanted to shed some light on that because it's so relevant at the moment. Thank you guys for tuning in. I really appreciate it. Please like, subscribe, comment, I'd love to hear what you guys have to say. And until next time,